U.S. stock market, Monday morning, time 6:01 a.m., 8/1/2011, New York Stock Exchange, pre-market futures gap, debt ceiling resolution, Sunday night. The worst July on record since really, I think, in price action since 2004. Starting the new calendar month, they came out very conveniently last night. The NYSE has 60% program trading done. Anything above 1.00 is a gap. They're called upside volatility gaps. Just like we did in the NASDAQ futures, you can always go there this morning and make sure you do. This is a very long gap. But a week ago at this time, it was a big gap down because of all of that. And that price action volatility works both ways, mathematically up, ascending, and mathematically descending, greater values up or greater values less than within the actual price action ranges across the board of the indice components, index components. Bear and bull ETFs will be traded a certain way. The bear is trapped below the market. On the opening bell, the trade management on the NYSE will be as follows, is that once that bear has to cover and get out, and we go higher in our SMF platform up in the delta, the prices are there, is that once we get up there to the top intraday ratio high, delta high, there won't be any buyers up there. Once that short interest has been covered, buy to cover provides that long trade off support, and right up there it goes. The key factor is that once this processes happen on the opening bell, is where those reversals are by looking at 60 minutes and daily charts with reversal half bars starting with the 3-minute, working their patterns in to the other time frames. And the big money selling into the news is another thing. Earnings season is winding down. We're starting the tail end of the last of it this week, and there'll be some stragglers the week after. However, the bulk of what they had to say, GDP is at 1.3%. The ISM index will be coming out in 1 hour from now, along with construction spending, ADP, Challenger report, and the monthly jobs report all this week. The beginning of a calendar day. Is that money coming off the sideline and putting it together? Are they all bullish and hyped up over your so-called deals, which I'm not going to go into right now because it's pre-market? But once again, we'd already talked about this last week, all last week, and all the week before, and the week before that, and what it would look like. And it's doing exactly what we said it would. And how you would apply upside calls to price action volatility, because you'd already sold off from the highs in the market over the last couple of weeks. From the top down trade still remains the same. Same trade remains the same. That top down trade versus that bottom up off that bottom left elbow. The right elbow on the opening bell when they open up is how far they teeny up from there. So if I go up another half delta or fourth delta, but at that ratio it stops, is that means that the sellers are taking advantage of the move and selling into the news. It will be verified there. There are stocks in a shorter price volatility span. The upside volatility, I'm sorry, I had to come back on. The stocks that had sold off the most last week in the last 5-day range is we're going to be looking at what the last 5-day distribution was to the upside volatility, and if we have lower, meaning that the high is lower, and then we start to sell and slide that bid, half of that previous bar, and we start to go down, then we know that the volatility is selling at what? The higher lows within the price ranges, or lower highs coming into play as well. This is the gap up list compared to where CAT sold down. It had missed its earnings. Cummins sold back down, had a great earnings. Salesforce has been down in a downtrend. These are the kind of stocks on the NYSE that CMG is going to be more overbought. Some of these stocks are going to be really overbought from these gaps, and we'll have to take a look at them on a weekly and a daily as we progress through the week and the day and the morning. We have lots of work ahead of us, MMTs. The conviction remains with the buyer and the seller, which is a public buy and sell tape, and what that interaction between those people are going to be at certain market price action levels in the SMF platform. It will be confirmed when the ratios change, whether they're descending ratios from highs or ascending ratios from consolidation or left elbow gap downs. There's not going to be too many of them. Here, the gap down list isn't very big. These are earnings related right here, some of them. But you have a very small contraction down. Okay? So, what I want people to do, MMTs that is to go back to a week ago at this very time so that you can see clearly the price action volatility increasing. We said that it would increase extremely. The trade management remains the same as last week. The only difference is that you have to let the process of the bear cover the short. Once he's out up at the high, you'll look for the half bar reversal. And the other key to it is that if it's only a 369 to support, and then it just has your little bid pops in there, you'll come out. If the reversal has contracted in price, then it means that they're still fairly strong and can consolidate price action weakness before they finally pull in as well. And or the very vice versa of breaking higher highs is as they would diminish the pullback. You'd have to come out, and if they're really elevated and strong in the cycle, they can make higher highs and then start the process over at the next high. It's carefully to monitor, and where that institutional money is selling the pre-market NYSE gap. We do have some earnings in here. Some of these stocks, like CMG, are going to be extremely in overbought territories. We'll go through that later. It's how to trade the opening bell, U.S. debt ceiling, everything that we talked about, volatility between a bull, volatility between bears, volatility between headlines, volatility between trade management, and how do I make sense of it and why.